recent, as I recall. All right, why don't we kick off, everyone? Thank you all for being here. Thank you to our special guest, Nick Philpott from Zodia. Before we begin, everyone, our usual disclaimer is please keep in mind for this joint working group meeting that subject to our confidentiality and antitrust policies, nothing discussed is considered accounting, investment, legal, or tax advice. Any advice coming from me, ignore out of the gate. We are recording this session. It's a relatively small group. Some folks, Nick, will dive in. For the group here, we had the wonderful opportunity. Thank you, David Wysocki. Thank you, Chris Broderson, for connecting us with Nick Philpott and Zodia. Nick, let me give you the floor a little bit. Talk a little bit about Zodia. I'm sure there's questions that are going to be queuing up. Because it's a small group, do the hand raise, please, so we can give proper time for Nick. But Nick, over to you.
Yeah, thank you. So Nick Philpott, one of the co-founders of Zodia Markets, which is majority owned by Standard Chartered. So I spent 16 years at Standard Chartered after leaving the British Army in 2006. Spent my career in a variety of financial market roles, so on the trading side of Standard Chartered's business. Starting out, did some training in Dubai on the Africa FX desk, then worked in Lagos, Nigeria, covering financial institutions, a stint in the COO function, trading in Singapore and London, and then finished up as the head of market structure in the electronic trading division. So in that last role I had, we wound up working with the Libra Association. This is public knowledge from 2019 to 21. So Libra was Facebook's sort of stablecoin project, and they went out to their relationship banks looking for support. I developed, I suppose, a reputation as a crypto bore in the London dealing room. So I was asked to go off and meet Facebook and find out what they were talking about, because our relationship manager for them was quite confused. I then met the gentleman, a guy called Max, who set up our sister company, which is called Zodia Custody, which was set up about 18 months before Zodia Markets. And in the fullness of time, he asked me to set up a markets version of Custody. More on that in a second. The year before, in 2018, Standard Chartered did a Bitcoin test trade with a counterparty called OSL. And that was done by the electronic trading team. And it was very much like rolling a wrecking ball, Indiana Jones style, through the systems of the bank. What the currency codes didn't break, the decimal places broke the rest. So that is what helped us understand as a bank that we were going to have to go down the ventures route and partner or create from scratch systems, for example, on the market side, that could deal with T0, live risk updates, all those sorts of things. So no more batch cycles because it's too slow. So Libra was killed by the US Treasury in approximately 2021. So from 2020, I'd started working on Zodia Markets as a project. We incorporated in 21 with our minority shareholder, OSL, and we commercially launched in September 2022. The reason why we created the two companies separately, so Custody and Markets, was we felt that crypto was doing a poor job of segregating custody and execution. So I'll give you an example. So FTX, the Sam Bankman-Fried fluffy-haired character in Bahamas, who's now doing time at in the US Department of Corrections, he combined the activity of being a custodian, being a market maker, and doing execution brokerage. And eventually he had his hand, in the client fund's cookie jar, huge conflict of interest, and it ended the way it ended. We wanted to make it really obvious that we were vigilant to that risk. So hence we created the two companies, Zodia Custody, Zodia Markets, both UK incorporated, registered with the FCA, which is the best you can manage in the UK at the moment. Different cap tables, different management. Now we do come as a package with them, but we work with other custodians. So we use Coinbase Custody and Fireblock's self-hosted wallets, and equally they work with other brokerages and exchanges. In terms of the services we provide today, so we specialize in what we call stablecoin on and off ramping. So stablecoins, and please tell me if I'm being overly simplistic, explaining things that you guys already know. But stablecoins are basically a representation of a fiat currency, usually a fiat currency, that use the same blockchain-based infrastructure as Ethereum, Solana, and various other digital assets. Put short, it's basically a US dollar or a representation of a dollar on the open internet. Because at the moment, payments as we make them today, so for example, Fedwire is not a internet-based system, fundamentally. It is a series of Oracle database clusters run by the Federal Reserve. In the UK, you have CHAPS, UAE RTGS, where I'm sitting here in Abu Dhabi, and so on and so forth. So all of these systems are centralized databases, and they don't necessarily talk to each other, nor the banks who have to provide payment instructions in order to debit a balance at one bank and credit a balance at another bank. Stablecoins, everything's internet-based. We don't serve retail, and everything we do is first party. So effectively, we're a matched principal broker. Not quite riskless principal, because we're taking a degree of counterparty settlement risk and hedging risk, but fundamentally we're a matched principal broker. So we treat it very much like foreign exchange. Customer will KYC, sign our terms and conditions, do operational testing, and then they're live. They'll come to us, ask us for a quote, say Circle USDC versus Turkish lira. We will provide them an all-in price. If they like the price, we execute a trade, we proceed to settlement. They will deliver from their bank account to our bank account, Turkish lira in that case. We'll deliver stablecoins from our wallet to their wallet. All settlement in crypto is T0. So you're doing same-day execution. When I say T0, I don't mean T0 in bank terms, which is T0 at the end of the day. I mean T0 as fast as possible. So our operations team, who are mostly ex-repo people, because repo people understand the idea of intraday settlement, whereas FX people, being an ex-FX person, would probably freak out slightly. I have an SLA of about an hour. So we'll settle transactions anywhere between about 30 minutes and 90 minutes, somewhere in that bracket, but they're aiming for an hour. The hard part of running any digital asset company is cash. The stable coins and the crypto will pretty much do what you want them to do. We use custodians to move them, or self-hosted wallets to move them, in the same way that we instruct a bank to do our cash legs. But the problem is the cash, because the cash doesn't work at weekends. Crypto doesn't work after banking hours. It has cutoff times. Stablecoins don't have any cutoff times. Settlement speeds are varying, whereas a slow stablecoin on the Ethereum blockchain will settle in 12 minutes. Solana, it's about 300 milliseconds. So it's extremely quick. We're then decomposing that trade. So that was a USDC versus Turkish lira into two hedge trades. We'll do dollar Turkish lira with Standard Chartered's foreign exchange desk. And then we mint, that's one trade. And then we mint USDC with Circle, the stablecoin issuer, and we directly interface with all of the major stablecoin issuers directly. In terms of client base, the clients split broadly into about 4, maybe 5 groups. So we have sort of hedge funds, a couple of asset managers, and the odd pension fund who are trading sort of traditional crypto, Bitcoin, Ethereum, Solana, stuff like that. There's a few ETP issuers in there as well, but that's about 10% of our revenue. So it's pretty small. The rest is all stablecoins. Of the rest, about 80% is VASPs, so virtual asset service providers, so crypto exchanges, crypto companies who are using us to manage their FX. Because if they went to a normal FX broker, they're not going to get fast enough settlement. They don't really care about the pricing. The pricing just needs to be vaguely sensible. They need fast settlement, because it's no good running a crypto exchange where all of your assets are dancing around 300 milliseconds or 12 minutes, and you've got cash legs that are settling tomorrow, the day after tomorrow, and so on and so forth. You'll just wind up with legs up in the air all over the place. We're also helped there by the fact that a lot of crypto companies still can't get access to basic bank accounts. So when I had the epiphany of looking into FX provision within the digital asset market in April 2023, I can actually pinpoint it to a particular conference I was sitting in. I'm incredibly bored. We did an informal survey amongst some of our clients. And to give you an example, we have a customer here in the UAE, United Arab Emirates, which was getting 400 basis points to 4% on dollar dirhams from its local bank. Because it's a crypto company, so most of the local banks just said, no, crypto is outside of our risk appetite. The one bank that said yes to them said, I know you're not getting banked anywhere else. So here's a foreign exchange rate just for you. And you'll take it and you'll like it. And 400 basis points, you can do better at the airport. I checked. So we come in, we've got the foreign exchange coming in from Standard Chartered. we're pricing that single or low double figure basis points. And it's a very, very good business. And these guys are doing millions a day. The next client base we have is cross-border payment companies, so remittance companies in particular. So they're using stablecoins effectively to address the vacuum that's been left by the retreat of correspondent banking over the course of the last 15 to 20 years through banks de-risking various jurisdictions. Simply a case that you just cannot get dollars into some jurisdictions particularly quickly at all anymore, because so few local banks have decent access to dollar correspondent banking, let alone euro or sterling or any other currencies. The next group is NGOs, so non-government organizations. So they're using us again to replace correspondent banking, and that's trying to distribute aid to various different high-risk countries. The last group, which is arguably the fastest growing, is oil, iron ore, soybeans, steel manufacturing, shipping, and port operators. And what they're doing, same sort of thing. They're using stablecoins because the settlement is significantly faster. And also they have to grapple with very, very challenging payment corridors. Every country is an importer or an exporter. So definitionally in those industries, you're having to deal with some quite normal payment corridors, US to the UK, Singapore to Hong Kong, but you're also dealing with some absolutely horrendous payment corridors. So to give you an example, the soybean miller that we serve, they have a problem. They're the absolute, they own 50% of all the soybeans in Iraq. Very, very difficult for an Iraqi farmers cooperative or agribusiness to get a dollar bank account. Even if they get the dollar bank account, very hard to buy dollars. So instead what they're doing is they're buying stable coins locally and they're paying our customer with the stable coins. We're then liquidating the stable coins for our customer into Turkish lira. Pretty straightforward. In terms of KYC, AML, we use and sanctions, we use the exact same policies and standards as our majority shareholder, Standard Chartered. Although we believe we go slightly further, because what we're doing is we will tie your real world identity, which we'll ascertain through KYC, to your on-chain identity, which is your wallet address. What that allows us to do is to see every single transaction you've ever done. We don't necessarily know who it's with, but we can use third-party software providers. We use TRM Labs, but others like Chainalysis and Elliptic, to look at the blockchain and see if you've had any close or reasonably close relationships with wallets that are associated with illicit finance. How do those companies find those wallets? So they scrape the internet. So if you've got a website saying, please donate Bitcoin to my terrorist organization, here's the address to send the Bitcoin to. So that address now goes on a list. Similarly, OFAC lists specific addresses for wallets. I note that they don't list IBANs. So it's much easier for us to look at a particular address and see if there's a relationship to any of those addresses. So that's how we address the KYC AML issue. In quite a lot of the jurisdictions we serve, stable coins trade at a premium to dollar deposits. So I'll give you an example. Again, Turkey's a really good example. Last year, that premium was about 50 basis points, 50. The reason for that is it's very, very difficult, if not impossible, for the government to do in Argentina and expropriate stablecoins because they're not in the banking system. Number two is stablecoins are capitalized at 100%. So that means they are 8x better capitalized than a domestic bank. And that's on a good day for the domestic bank. And thirdly, the utility of the stablecoins is much, much easier because they'll settle T0 24/7, no cutoffs, no restrictions. I feel like that's probably quite a lot to start with, and I'll pause to see if anyone's got any questions.
Nick, I'll dive in because this group knows me and knows I always have arguably silly questions. I wanted to ask two of them. One was, and I think a lot of my colleagues and I here, for years I had been saying institutional engagement's coming, institutions are coming, and then something would blow up. You referenced FTX, and that happened cyclically every, it seemed, 18 to 24 months. Has the tone and tempo of that institutional kind of engagement, is it an easier conversation across all of the customer profiles you're talking about now?
It depends. It's a much easier conversation with the commodities traders.
Yeah.
So those are not regulated by. So the regulators are still, I think, existing in a world where the knowledge of digital assets is still quite thin, and it tends to be geared towards wanting to protect domestic retail from having, I use the crude term, they don't want offshore exchanges selling shitcoins to Main Street, which I completely get. We don't do that. We don't serve Main Street, and we certainly don't partake in garbage coins. What we're doing is just stable coins versus foreign exchange. We're basically trying to provide an alternative, not necessarily a replacement, at least not yet, but an alternative for cross-border payments in particular. Because how would I characterize this? Stable coins are a possible means of addressing the 20% of your cross-border payments that cause you 80% of your headaches. So you don't mind sending money between the US and the UK or between Singapore and Hong Kong, but it's that one payment that you have to make to Angola to buy oil from there that you just dread having to make every month. You know the logistics guys are going to shout at you because you failed to pay on time because of the banking system, and now you've been hit, or they've been hit with demurrage charges. So that's the first thing. The banks, certainly the tier one banks, are broadly nowhere as far as I can tell. There's a sense of panic, I suspect. There's a couple sort of running around coming and saying, should we run a stable, we do our own stable coin?
Yeah.
You know, SocGen is looking at, is doing that, for example. And they're still, I think, vacillating a bit about some of the alternatives like central bank digital currencies. So in the US, that's looking like it's heading towards being illegal. So that will at least stop the debate, which would be nice. I mean, my observation there would be that central bank digital currencies, they're going to struggle to work on a cross-border basis.
Yeah.
So yes, you could probably network up G10, possibly G20, but someone's going to have to go and tell the Egyptians, the Argentines, the Indonesians, and a whole long list of countries that they don't get to come and play. That's an awkward conversation. And if you do think that the networking can take place, we have 180 currencies in the world, so that's 16,000 plus bilateral links. And the last example I would use is CLS. So CLS has been trying to do the same thing. It's effectively trying to network up central banks. It's been doing that since 2002. It's done 18 banks so far. So at the current pace, they'll do the next 172 currencies in about 200 years' time. It's not going to happen. So let's just park that. Tokenized deposits have utility. So JP Morgan coin, KINXS, whatever it's called now. That makes sense in terms of making your existing clients stickier. It's effectively a much more efficient book transfer system. The problem with it, though, is you've drawn a hard perimeter around JP Morgan. Yes, you could create a consortium of banks, but ultimately you have that perimeter. And the problem we're solving is that the correspondent banks have withdrawn from a lot of these countries to de-risk them. We have clients who would crawl through broken glass to get a JP Morgan bank account. They're not going to get one. So tokenized deposits is off the table for them. You could put tokenized deposits on an open permissionless blockchain. That would be hilarious because it would be great to trade because the coins would be haircut based on the counterparty risk of the issuing bank. I would not value Bank Piraeus coin at par with BNP Paribas coin. So it'd be like some weird physically deliverable CDS market. It would be brilliant, but no good for making cross-border payments. Wildcat banking from the US, 1872. Security tokens won't work because you need a securities license in order to distribute them anywhere, pretty much. Also, you need to be KYC'd. The issuer needs to KYC the holders in some cases. So BIDL, BlackRock's BIDL, which is a fantastic coin, and we're looking at working to distribute that, has some very good use cases, certainly within financial services, accelerating the speed of collateral movement. But in my opinion, that takes the financial services system out of 10 from a 7 to a 9, maybe. What we're doing with stablecoins is taking cross-border payments from a 4 to a 9. So the potential benefit, I would argue, is significantly greater. Also, one anecdotal observation, one of the use cases we have is with ship owners buying and selling ships using stablecoins. We broached the idea, would you consider using a BlackRock money market fund? but you've got to be KYC'd by BlackRock. We were laughed out of the room. We highlighted the point, well, surely your banks also KYC you. The Greek billionaire ship owner turns around and goes, well, of course, I own the bank. So problem solved.
Yep.
So stablecoins, we think, solve this cross-border problem. Sonia, you've got a question, please.
Yeah, so it's an interesting platform you have, but how do countries like, let's say, the tropical countries want to get into this game? Let's say, some Aruba or Bahamas, and they want to, they kind of want to be part of this ecosystem or actually win or, probably establish their own coin or get on this platform. How do you see them playing out in this space?
I would argue that in many cases, they're actually ahead of the West. So in terms of stablecoin adoption, there's a company called Chainalysis, which does an annual survey or sort of ranking of countries in terms of crypto adoption, and it measures it on various different criteria. From memory, very quickly, the top 20 include Ukraine, Russia, Vietnam, the United States, the United Kingdom, the United Arab Emirates, Kenya, Nigeria, India, places like that. So Brazil, Argentina. It's not necessarily Aruba and the Bahamas, but what I would characterize it as, the use case is very common in emerging markets. So to give you another example, a friend sent me a photograph from La Paz airport in Bolivia, and you can see that food in the airport is being priced in Tether, which is a stable coin. It's not being priced in domestic currency, it's being priced in Tether, and it's not being priced in dollars either. What that speaks to further sort of go deeper into your question, Sonia, is with the passage of the Genius Act, excuse me, dollar stablecoins now are very likely to wash across most of the world. So this will probably be one of the best delivery mechanisms, deliberately or not, of the US dollar globally. Because fundamentally, there's not a huge amount that the governments can do to stop it. Stablecoins are based on the open internet. So the only thing you can really do is turn off the open internet. And if you think that you can do that and there's not going to be a backlash, then have a quick look and see what happened in Nepal over the course of the last 10 days when they tried that, admittedly with a different objective. But Parliament got burned down. Prime Minister's wife is dead. I'm pretty certain the Prime Minister was literally thrown in a river. Like, you don't turn the internet off. So you can't do that. You could put a great, sort of great firewall style defense up, so similar to China, in which case I have a VPN to sell you. So that's not going to happen. Second thing you could do is you could try to run your domestic currency so that your nationals don't want to short it. In many cases, that's not going to happen either. So to your question, to your point, we've started being approached by some central banks, which is quite interesting, where they're very sensitive to this notion of the dollar is just going to wash across the country. So what can they do? And that brings them to local currency stablecoins. So in terms of our volumes, just to illustrate the point, in the first half of this year, we traded about $36 billion worth of dollar stablecoins. The second largest currency in terms of stablecoins that we traded wasn't the euro, wasn't sterling, not the Swiss franc, it's not the Canadian dollar, it's the Turkish lira. We did 3 billion year to date. Then there's a massive gap. And then there's euro stablecoins. I think we traded 50 or 60 million in euro stablecoins. There's just no demand. But Turkish lira is counterintuitively, it's a very unstable currency. So why on earth would you have a stable coin pegged to something unstable? Very hard to get a Turkish lira bank account offshore. Very easy to hold Turkish lira stablecoins offshore. Turkey is an import-export market, so it has a huge cross-border use case. It has a huge diaspora in Austria and Germany, so there's huge remittance flows. That's more cross-border use cases. It's got a very young population that trades crypto anyway, so that's another use case, and on and on and on.
Right. I mean,
so that's the use case.
If I may, so
please,
yeah. So, could you just explain why, in terms of like international trade, why you would really want the local currency stablecoin there instead of just using the dollar stablecoin?
Yeah, no, it's a good question. So in some of these jurisdictions, let's take, for example, one of the oil companies that we work with. So they own a petrol station forecourt business in Turkey. So they're getting paid with Turkish lira. So they would prefer to convert that into TRYB because they're running their treasury from, it's either Singapore or Switzerland. It's one of the two. It begins with S. Can't remember which one. So that means that they can manage that treasury remotely, and then they can switch in and out of US dollar stablecoins with the counter currency. But the TRYB, which is the stablecoin, doesn't have cutoffs, doesn't take holidays. So if a ship arrives late at night on a Saturday, you can pay.
Brilliant, thanks. I'm just wondering if in the long term, right, you explained like over the next couple 100 years, we'll start to see some other currency stablecoins. It seems that maybe what you'll see is just instead of receiving, lira in the first case, right, they'll just receive dollars. There'll just be a switch over.
Yeah. No, I think in some jurisdictions they will. That said, I think, and this is now a personal opinion, I think that certain currencies will have a good swing of the bat at being a regional currency. So the Kenyan shilling is a great example. The Kenyan shilling is already a regional currency because it was put onto, not as a stablecoin, although it is effectively a stablecoin, to mobile telephony under M-Pesa in 2005 by Safaricom, Vodafone, and DFID. So it's in use across the whole of the Horn of Africa and East Africa. So if the Kenyan shilling was put on to one of the blockchains and made available sort of almost in parallel as a stable coin, then I could see it displacing the South Sudanese pound, whatever they use in Somalia these days, and so on and so forth. Because don't forget, this is all contextual. If I'm sitting in Somalia, then whatever I'm using, I think it's the Somaliland pound or something like that, is far worse than using the Kenyan shilling next door. And if I'm doing cross-border trade, if I've got family living next door, then that's much easier. I don't necessarily need to go through the pain and the cost, don't forget, of buying US dollars. Because US dollar stablecoins trade at a premium to dollar deposits.
David Wysocki, go ahead, buddy.
Yeah.
Thank you. Really quite eye-opening, and it's not a surprise that someone experienced in FX repo markets has found his way into this field. It's such a natural progression, so kudos to you.
Thank you.
Would just on a general theme, would you offer some thoughts as to the kind of issues regulators in the U.S. Will need to consider as we adopt a stable coin footprint here, payment stable coin footprint here?
Yeah.
What are the kinds of things that you've learned, the lessons that you've learned from the engagement in a more illiquid market and smaller scale? But you've seen what works, you've seen what problems people are trying to overcome in their markets. What are some of those touch points that our regulators should be thinking about, and we as market participants should be considering, both good and bad? What should we avoid and what should we be striving towards?
That's an outstanding question. Genuinely, very, very, very good question. So I'll start with just risk frameworks as a practitioner. So we use the same standard chartered risk framework. I believe it comes from the FCA, and you think in terms of the principal risk types: capital, liquidity, credit, market, operational, reputational. Now, the only areas where we had to really create something greenfield, so brand new, was number one, was how we look at custodians and wallet providers. So where are we keeping the coins? The reason for that is because it's actually a series of different principal risk types all mixed into one. So it's information security, about how easily can it be hacked? Excuse me. It's operational. So can they give us the reporting that we want? What's the instruction mechanism like? What's the riskiness of their operational risk internally? What are their controls like, and so on? It's credit risk. So if they lose all our funds, are they insured? And so on and so forth. So you're thinking about in a whole range of different through a range of different prisms. The second one is how we analyze blockchains, and by extension, the token that comes with the blockchain. So we look at Ethereum, the blockchain, and ETH, the token, separately. Okay, and we have to handle both because we need ETH to pay the gas fees. Think of that as sort of vaguely analogous to Swift, or it's more like an RTGS fee. Think of it that way. So we need to look at that. And then layer on top of that, how do we analyze stablecoins? So that's the third. Now, analyzing a stablecoin, and this is where I slightly reject the premise that, oh, we need regulatory clarity to be able to participate in this market, because in my opinion, you can actually take a lot of pre-existing rules. You might need to tweak them slightly, but you can apply them to digital assets reasonably easily, okay? So stablecoins, fiat-backed stablecoins, I'm referring to, not the algorithmic lunacy of Terra Luna, it's basically a money market fund, pretty much. And you need to squint a bit, but that's really what it is. And you can analyze the risk of a money market fund reasonably easily. You've then got to layer on things like, again, operational risks, so the minting and the burning, so that's the issuance, the redemption, the purchase and the sale, whatever phrase you want to use. But you're fundamentally looking at how do they govern what they're investing in? So are there governance and controls in place to stop the committee, the investment committee, the reserve management committee, whatever you want to call it, from waking up tomorrow, convening a meeting, deciding to take it to Reno and put it on black? So we've got to control against that. You can trace that, and incidentally, you can trace a lot of the stablecoin rules back to the US money market fund rules in the wake of 2008. So that then was what informed the NYDFS's rules around bit licenses and the operation of stablecoins there, which in turn informed the Genius Act. So it's a fairly straightforward sort of linear process. Similarly, if you've got rules around counterparty credit risk and things like that, then again, it's the same theory, you're just doing it much faster. So a lot of our trades are done on a DVP, a delivery versus payment basis. Client delivers the cash, we deliver stablecoins, and we tend to focus on delivering the cash leg first because cash is slow and unpredictable. In terms of the sort of more sort of extraterritorial sort of geopolitical side of things, I mean, that's not so much for the regulators, that's more for the US Treasury, in which case you're raising questions about how big are these stablecoin issuers going to get. So just to give you an idea, so Tether, which is the #1 stablecoin issuer in the world by market cap, it's about 170 billion. They own more, if they were a nation state, they own more treasuries than Germany. So they're pretty big deal. So what impact is that going to have on the US Treasuries curve? Probably quite good, I would imagine. Scott Percent needs to sell lots of T-bills. But then what does that do to potentially to the banking system? Now, the US banking system, I think, is going to be fine, broadly speaking, because as I said, stablecoins tend to have a cross-border use case. I think the problem is actually going to be much more on the emerging markets bank side, where people are going to go, I'm holding my dollars. In fact, I've had this exact conversation with a ship owner. Sure. I'm holding my dollars in a bank in Congo, Brazzaville, which I feel intensely uncomfortable about. I would much rather hold those in a digital wallet, in stable coins. I can manage it from my treasury in Belgium, and I don't need to worry about the government of Congo, Brazzaville, or the bank in Congo, Brazzaville. So I can see dollar capital flight out of a lot of these banks. So Manny, you have a question?
You're on mute, Manny.
Oh, sorry, yes. David, did that answer your question? Did you?
Perfect, spot on. Okay. Please,
okay.
I appreciate it. Manny, please go ahead.
Thanks, David. Since we talked about repos, I come from capital markets background. I've been building an OTC digital marketplace. The one interesting area where we see, because as you mentioned, the velocity of the stable coins is in a different compared to the velocity of the cash, and the fact that you have to have a reserve management to meet all the Genius Act, Stable Act. You need to have an intraday treasury management and repo management. This is where we are betting on. And more interestingly, we think that if we bring a market that settles every hour, I'm talking organized secondary market, execute and settle, that's what you're working on building. And your take on what do you think about it, and how this is going to solve the capital markets problem?
This is like the best crowd I've ever spoken to. Yes, I completely agree. So
You
if you're
get
using-
invited back next week then. Thank you for the
Thank
kind
you.
words.
No, it's a great. So with stable coins, if you're you're absolutely right. If you're moving money at extremely high velocity, what you're doing is you're decreasing counterparty credit risk, particularly if you've got stable coins on both sides. So that USD stablecoin versus Turkish lira stablecoin I used earlier, those are on the same blockchain potentially, which means you can do payment versus payment. But elegantly, I don't have to wait until Turkey and the United States are open at the same time, which is what I have to do with CLS. Turkey's kind of okay. With Japan and Singapore, those windows are like 3 or 4 hours long every day. So I have to cram the whole of dollar yen CLS settlement into a 4-hour window or 3-hour window. I can't remember. It's one of the two. So ultimately, if I can bring everything onto the same infrastructure, then I can decrease credit risk quite massively. But exactly to your point, I'm going to massively increase capital and liquidity risk, which is why I would try to characterize stablecoins, certainly in the short to medium term, as a complement to existing correspondent banking. It's going to help you solve for the 20% of payments that you need to do right now, right? But a lot of corporate treasuries are still going to be, I can settle at the end of the day, I can settle tomorrow, it doesn't really matter, I will be okay. But it's slightly galling that at the moment, if you look at just RTGS queues, for example, it's done generally on a first in, first out basis. Yes, you can have some liquidity saving mechanisms and things, which is kind of multilateral netting, but that's fundamentally what you've got. So you've basically got a queue, and you don't actually have the ability to pay a little bit more to jump the queue, which is something you can do in digital assets. So if I've got a transaction that I want to get into a block, then I can pay higher gas fees to skip the queue. RTGS doesn't have that, which is quite galling. Soviet bread queues had that technology, but RTGS does not. So exactly to your point, Manny, what we're going to have to create in the long term, the medium potentially to long term, is to create a cash market that operates on a T0 basis in the hour. What you might be interested to learn is that the biggest prime broker in crypto does not lend by the day. They lend by the 4-hourly increment. Because if I need to borrow, to your point, if I need to borrow dollars for 4 hours, I don't want to pay for the other 20. And that's where the world is going to get to, I think. How that's going to look and how that's going to mesh with the treasuries versus cash repo market, I don't know. Chris would.
Yeah, so you talked a lot about, the timing differences when the bank is open, blah, blah, blah. So yeah. Let's say I am one of your clients. I contact your firm on Sunday afternoon and say, holy God, the ship arrived early and they want their money. But the bank's not open, so I can't pre-fund the movement of the money to a stablecoin to facilitate the payment. So how do you handle that? Is that your
handle that? Yeah, so the way we do that is we have a credit line from Standard Chartered in our name, so our majority shareholder. And what we're doing is we'll draw down from that credit line, and then this is public knowledge, I'm not telling you anything I shouldn't. So we book transfer cash from our bank account to Circle's bank account, which is a stablecoin issuer. They bank with Standard Chartered Singapore. That book transfer system works 24/7, and it settles in, actually we timed it, it's 3.5 minutes. The stablecoins then appear in 1:22 after, so 4 minutes 52, we can get stablecoins to you. That is limited by the credit line, but we've designed what we've created to be able to accommodate at a minimum a VLCC tanker of crude oil, which is, I haven't checked the last time I checked a couple of weeks ago, it was $130 million. So we can do that in a single ticket.
So as a client, you onboard me as a client, and then based on your risk assessment, you give me a credit line, right?
Correct.
And then I assume you charge some sort of premium, but only when I'm actually using the credit for those 20.
The overnight funding rate. If, as is the case with some of the oil and gas guys, they're banked by Standard Chartered as well, then they book transfer cash to us, we book transfer cash to Circle, and the stable coins appear. So this is one of the huge strategic advantages that Standard Chartered has almost, we've discovered for them. Because I'm not allowed to sell bank products, but I'm sitting next to bank relationship managers where I could say, and if you don't have a bank account, this chap here sitting next to me can help you get it set up. It's not perfect, because if you don't bank with Standard Chartered and you don't have a credit line with me, I can't get that to you. But at least if we do put that in place, now you have another tool in the box, so to speak.
Right.
And so the other thing I would overlay is with cross-border payments, people talk about 2 costs, whereas we believe there are 3. The first cost is the explicit cost. How much am I going to have to pay? What's the spread that Zodia Markets is going to charge me? And what's, if there's a payment fee, what's the payment fee? That's the explicit cost. Second is the implicit cost. So days of capital in use. So if a cross-border payment is taking me 5 days and I could have put those funds onto deposit in 5 days, what's the opportunity cost of the fact that the cross-border payment takes a ridiculous amount of time? So that's the implicit cost. The third one is the psychological cost, which is increasing, well, it's 2 parts. So increasingly, when you make a cross-border payment these days, particularly to an emerging market, it feels like you're placing a bet. Is it going to settle today? Is it going to settle tomorrow? A couple of days from now? Is some outsourced KYC compliance team going to have a look at the payment, completely misunderstand what's going on and freeze it while they investigate? And I have no recourse to them because it's hit a correspondent bank that I don't have a relationship with. Or to your point, Chris, maybe the ship's going to arrive a day early and it's going to get there on Sunday, in which case I'm going to get hit by a 1-day demurrage charge, which on a big ship could be a lot of money. So that's the psychological anguish that we're trying to deal with. That makes sense.
I mean, it sounds like, this group has talked about it a lot, but part of the problem with the broader tokenization model, whether you're talking about stable coins or equities or bonds or what have you, is the pre-funding of every trade, right?
Yeah.
And the capital that is required, right, David? I mean, you and I batted that around forever.
Yeah, I mean, it's the fundamental distinction between a credit-based transactional system, whether in finance or in commodities, and one where you effectively do not need a credit line, or the credit risk associated with your order is eliminated because you have to pay up front.
Yeah, correct.
So Sonia, you had a question. You had a hand up.
So do you see a lot of import?
I don't want to lose the point.
Import-export companies using us to capitalize. So yes, we've seen a massive uptick in import-export companies literally in the last 6 months. I think the penny, the stable coin, has dropped, to make a clumsy joke. And it's oil, gas, metals, mining. Now there's probably 2 reasons why that's the case. The first is that a lot of the banks that are doing stuff in real-world asset tokenization and things like that, they're tokenizing bonds, carbon credits, private credits, other bits and pieces, which all tend to be financial instruments. So as a result, they're having to go at the pace of the local regulator and wait for regulatory clarity, or indeed they're going into sandboxes, which is, can become a little bit like the old Hotel of California. You go in, you never go out. The commodities companies, however, are not regulated by financial services regulators, and fundamentally they just need something that works. Now they're big companies, so they have the sophistication to be able to understand blockchains, and indeed many of them have tested blockchains about 10 years ago: TradeLens, Marco Polo, Sarai Contour, IBM Hyperledger R3, and so on and so forth. So they've got a reasonable understanding there, and obviously they can analyze things like money market funds, which means that in turn they can then analyze stablecoins. It's not a huge leap. In terms of tariff impacts, probably not so much. It does mean that the dollar flows tend to be much harder for central banks to detect, but I would say that's probably less of an issue from a tariff perspective. A personal opinion is that I think the United States government, or the Department of Trade, should try to encourage anyone who's trying to buy goods and services from the United States to pay in stablecoins. Why is that? It's because any stablecoins that they're then forced to buy are backed by T-bills, which means you've now got a much bigger buying constituency for T-bills, and hopefully the US debt curve will come down. Something I wish the UK would do, but there we are. Sonia, did you have another question from the one you typed?
No, that's the same thing, but I do see a tariff reduction in some ways, right? Because they get an FX hedge. They get an FX hedge to it, and they will reduce in terms of, because of the settlement cycle, and in terms of the way they can actually do it in smaller packages, and they can actually reduce the tariff impact in import-export company. Like the perfect example you gave about the shipping company, you know, not comfortable keeping their US dollars in some gondola bank or whatever the bank name you gave, but is
Yeah.
comfortable in keeping it in a wallet, it would help them, right? I
Yeah.
mean,
Yeah.
that,
Well, and in many cases, it's not even an FX hedge. It just makes the FX go away, because if you're just paying with dollar stablecoins, you're not using local currency at all. So that, I suppose, is the one frightening thing for certainly a lot of the banks and some of the treasury desks is, what do you need a hedging program for?
no, but
The guys.
it would be an FX hedge, right? For example, I know somebody who runs a nutraceutical company out here, right? He
Yeah.
buys his products in rupees in India, and
Yeah.
then makes, so instead of using rupees, like he would use stable coins, let's say,
Correct.
and
Yep.
that, so the rupee to stable coin conversion, he makes money there, right? Because
The exporter would, yes, correct.
he would make money on that.
Yeah.
The same
But
person who sources and exports.
But I suppose my point there is, let's say, for example, Exxon is exporting oil to India, right? And Reliance is buying it. So today, Exxon is presumably maybe getting paid in rupees. Let's just pretend they are. And as a result, is having to run a hedging program in Indian rupees. Now, instead, if they're just giving if they're transacting in dollar stablecoins, they don't need to worry about the foreign exchange risk at all.
No, but in case of oil, whenever you buy oil, when any other country has to buy oil from the market, whether it's whether Reliance buys it or whether they buy it for their flights, they always have to buy in dollars.
Yes, I suppose that's true. Yeah,
that's
that's
cool,
correct. That's correct. I suppose
and
my
that's the reason the airlines went down, right? I mean, if you read the history of the airline history during COVID, a lot of airlines lost because they didn't
yeah
they couldn't refuel their planes. They didn't have money for
yeah
it. They didn't
yeah.
have
Well, I mean, generally speaking, I think the wider point is that I could see a lot of people, being displaced from just domestic currencies. I'm having a look at, so I don't have, someone's put a post to the Wall Street Journal. I'm afraid I don't have a subscription, so I can't actually see the
I
article.
can share the PDF, Nick, for everyone. But Nick, Chris, did you want to weigh in?
Yeah, so basically, Nick, the argument, this comes from a former regulator saying
Yeah.
that part of the S&L crisis was born because of the negative impact that money market funds had in the 1980s.
Yeah.
There was a big discrepancy between what banks could pay on yield versus money markets, and it snowballed. And they're kind of making the same argument here, that why would I hold my money in a bank when I could potentially, use a stable coin. Now, stable coins are not supposed to pay yield in the United States, but somebody's going to find a way around that, and we all know that's going to happen. I just don't know how. Adam, you probably have a better opinion, or David, than I do. But have you heard anything from your clients, any concerns about these sorts of things?
Yes, we have, actually. Not my clients, but Standard Chartered's research team. So I co-author articles with a guy called Jeff Kendrick. And he's had some queries from treasury desks at one oil company, in particular in the United States, asking exactly that. So they're worried about bank deposits being swept out of banks. Now, to your point, yes, the ban on providing yield, I think, helps address the problem in the main. Now, outfits like Coinbase, for example, do say if you put USDC stablecoins, Coinbase is a shareholder in USDC, onto Coinbase, then you pay yield. But the yield rates, I would say, are not that competitive against money market funds. So as such, why would you put it into a stablecoin? Just put it into a money market fund. It's much easier. There's probably a broader observation. I don't know the US retail market well enough, but there's probably an argument to say that some banks just don't pay enough for the deposits that they're getting. I've seen some statistic that a very large number, it might be as high as 30 to 70, 50% of deposits around the world don't have any yield.
Right.
I certainly know a lot of my bank accounts don't pay anything near UK bank rate, which is ridiculous. We're writing a paper right now, Jeff and I, on the impact on the banking system. And as I said, I don't personally see that the threat would come so much in the United States, because you've got money market funds, because you've got alternatives. Maybe it'll force a few banks to be a little bit less stingy. The real fear, I think, is in foreign banks.
Right. Yeah. No, I totally understand where you're coming from. It's just, like anything else, what's the law of unintended consequences?
Correct. But it's a good debate, but also it's not a new debate. This is also in the paper. Because it goes back to the 1934 Chicago Plan, which was a proposal to divide between fully reserved money, which you use for payments, and credit creation. And that in turn goes back to a British debate, which was between the currency school and the banking school between 1821 and the Bank Charter Act of 1834. So it's a tale as old as time sort of thing. Stablecoins, I think, just represent a different technology for the currency school, because now the currency, you can actually attach quite a lot more intelligence to it. You can distribute it far, far more broadly than perhaps you could before. So yeah, simple as that.
Nick, may I bring you back to something you said earlier on? I don't remember the context, but you mentioned that there were jurisdictions where stablecoins trade at a premium to
Correct.
Local, I think to local currency.
Local currency, yes, that's right.
Right. So just, whenever I hear of a dislocation like that, and I'm sure you feel you're attuned to the same point, there's a trade opportunity there.
There is definitely a trade opportunity.
I'll go buy stable coins for $1 and I'll go ship them somewhere else where I get $1 plus a VIG. I'll get 50 bips. What did you say? Something I don't remember the amount.
It was 50 bips in Turkey last year. It's about 7 now.
So okay, so it's come down. I'm not exactly sure why, but
no, that was our fault because we're providing foreign exchange.
Did your trading desk make sure that they took care of the arbitrage and pocketed a nice amount of money and a bonus?
We don't have the mandate to trade the arb, but our clients do. So we've actually contributed to collapsing the arb.
That's what I wanted to hear, that the marketplace will find the solution to that problem. And now it's down to 7 bips instead of 50.
Yeah.
So, okay.
Yeah, exactly.
Very interesting. Is that just something that was idiosyncratic to one jurisdiction, or is that something we're going to see in every jurisdiction, where there will be a recognition, especially as stable coins flood a local market? And please go on.
No, sorry, it's a good question. I've got the question 100%. So it generally correlates with the creditworthiness, the strength of the domestic currency. So last year, to give you an illustration, at one point, the differential between dollar naira in Nigeria and USDT naira was 40%.
Holy cow.
It was astronomical. Now, naira is controlled. So being able to do left-hand side, the left-hand side market was basically a seller's market because corporates were desperate to come out on the other side. Now, it's a gray market. We don't touch it. We're not permitted to, nor would we, because it violates currency controls. But there are definitely actors that do. We know a couple of them. And, it's a tale as old as time. The difference that they have now is where before they were doing the naira leg onshore and then doing a dollar leg offshore. So they've got 4 different entities. Instead, it's now just 2 entities, fundamentally, that are doing the naira leg onshore. And then the stablecoin bit could equally be done between those same 2 entities, because the stablecoins are definitionally offshore. They're on the open internet.
Interesting. Okay.
Outside the banking system. So more broadly, if I sort of go back a little bit more, what stablecoins in particular, but digital assets generally represent, is a migration of finance and assets to the open internet. Now, tokenizing bonds and carbon credits and whatnot makes total sense. But the counter to all of that is cash. What are you paying for the bond with? What are you paying for the carbon credit with? If you don't fix cash, then it's all well and good being able to settle a carbon credit 24/7 in minutes. But if the cash doesn't arrive until the working day after tomorrow, you're where you started. So fix cash, you can fix all the other asset classes. That's the first thing. The second part is it will enable the migration of finance into the browser and into the app, figuratively speaking. So when you buy something online, buy your stuff, and then you get taken to a security page run by Visa, MasterCard, your bank, whoever it might be, Stripe, whoever, PayPal. You do your security stuff and you go back. So you've still got those payment gateways to interface between the payment systems, MasterCard, Visa, RTGS, FedNow, and the open internet. Instead, you're now going to get to a situation where stablecoins and digital assets and crypto is going to be on the open internet, so you can finally interface real finance, as in buying and selling stuff and services, with money, because the money will be internet enabled. Greg.
Yeah, Nick, thanks for doing this. This has been really, really informative, and thank you for the comment in respect of the expertise, or around the group. One of the things I'm interested in is you mentioned several industries that are taking advantage of stablecoins, iron ore, oil, et cetera, et cetera. I'm particularly interested, amongst other things, in the gold trade, and you sitting in the UAE, which is one of the central trading hubs for the world for gold. I was wondering if you're seeing anything sort of linking up between the two primary gold tokens, which are very, very easy, and stable coins, and how what is happening there. I'm quite curious on that.
We see a bit. So we support Pax G, so Paxos Gold. The demand is not huge, so we haven't really seen it yet. We've got an ETP issuer in the European Union that's looking to start doing a Bitcoin versus gold, Paxos Gold ETP. So that would represent probably for us the first sort of meaningful flow, I would suppose. I know that Tether as an organization is very, very keen on Tether Gold, XAUT from memory. So in the fullness of time, we'll support that. The Tether guys, and again, I'm not telling you I'm under NDA with them, but this is all sort of public knowledge. They've invested in Agro Token, which is a tokenization platform for corn, soybeans, and something else, wheat, I think. They were in discussions with the government of Turkey about tokenizing boron. So they very much have a thesis about hard assets. And they also, in the reserve that backs Tether, the bit that they've over collateralized, so the 6%, so which is whatever it is, about 9 billion. There's a component of that that's gold, because they're thinking along sort of central bank sort of style reserve management lines. Kind of makes sense. But thus far, it has surprised me slightly that we haven't seen that migration. But I suppose what we're sort of starting with as the first phase, which is the migration out of a lot of very weak currencies that probably don't have much, like the South Sudanese pound, I tend to pick on all the time. Like, what's it for? And people go, oh, well, sovereignty. Well, I was in El Salvador in January. They haven't had a currency since 2002. They got flag, they've got guys with guns, they got passports, they got national dish, a lot of music, felt like El Salvador. Or controlling, monetary policy. If the South Sudanese central bank doesn't control monetary policy, I'm not sure if anyone would notice. Like, let's be fair. So there's probably this initial migration from quite weak, possibly slightly unnecessary currencies into US dollar-backed stablecoins. And then potentially in the fullness of time, we might migrate into gold-backed stablecoins. And obviously, and this is probably why you're asking the question, Greg, gold's been on an absolute tear recently.
No, I wasn't asking it for that reason. I was asking if you're, purely for flows, because again, like the way gold is transferred, say, from African countries and things like that up to Dubai, reassayed, re-refined, et cetera, then I suspect that that a gold-backed stablecoin would be very useful in de-risking that entire process. I'm involved in a trade that does that. I have a resources background along with securities lending and repo. But the flows and the timing and this kind of stuff begs for that kind of link up between a gold-backed stablecoin and matching up, or trying to match up with flows coming through. And at every step, if you know or don't know, there always has to be assaying and and verification, and of course several layers of government and this kind of stuff, and then it's got to get moved out of TransGuard to somebody else, et cetera. So it's begging for this, I think, eventually.
I think it is, along with a lot of the other commodity markets. I think the other thing is that people have said, well, dollar stablecoins are dominant. What about a BRICS stablecoin, which doesn't make a huge amount of sense, because BRL is sort of deliverable. I mean, I'd have to pay a 38 basis point charge every time I do the FX as an offshore entity. The Chinese yuan is restricted, so I could use CNH maybe. India, I mean, crypto is sort of banned. It's hard to tell. But certainly getting access to INR to mint it and burn it it would be very, very difficult. And Russia is completely off limits. So in that case, I could see if those guys at least want to try to get some sort of counterpoint to the total dominance of dollar stablecoins at the moment, I could see them maybe starting with gold tokens and trying to figure out how to at least create some sort of way of exchanging their currencies between them. But it's an interesting question. I haven't thought it through hugely, but so far we haven't seen a large amount. I've got one Turkish client that's approached me recently. They own a gold refinery in Turkey. So maybe that will be the first. We'll see.
Nick, I want to be respectful of your time. I know you're several hours and time zones ahead of us. I can't thank you enough for your time here. Hopefully you can come back. We have these conversations on a regular basis. We've got this recorded. I'll share that with you as well. I saw the Telegram, Nick, Nick _ at Zodia Markets for anyone who wants to reach out. Nick, any final comments, anything you want to leave us with? And hopefully we can do this again in the future.
Hopefully I'll leave it on a super positive note. So my background is not in cryptography. It's not in mathematics. It's not even in finance and economics. I have 2 degrees in history. So what I would say to reassure you all is, as much as crypto likes to paint itself with sort of new verbiage and terminology and all those sorts of things, a lot of that is just guff. It's just made up terms. Actually understanding wholesale financial services is probably the more important part, and then being able to translate that knowledge into what is fundamentally just slightly newer tools that are slightly quicker and behave in a slightly different way. But it's very easy to learn. It's very straightforward to learn. There's a couple of podcasts I've put up where I'm interviewed by others, but I go into sort of the basic mechanics of how the blockchains work and all that sort of stuff. That can be understood, at least at a very high level. So don't panic. Don't be intimidated by anyone who comes at you, particularly management consultants, with sort of obfuscatory language. This is an accessible space. You can learn it, and there's so much that you can do here.
Nick, thank you so much. I'll follow up with you again separately. If there's no last questions, David, Chris, with your permission, we'll end it here. Nick, looking forward to chatting again soon.
It's a pleasure. Thanks very much. Bye-bye.
Thank you.
Thank you, Nick.
Bye-bye.
Bye.